Hi there, and welcome to Modern AI Trading. In this video, I want to talk about Nassim Nicholas Taleb and his investment strategy. And the first thing I want to say is that I really find him an interesting and entertaining character. I know it can be difficult to put up with his writing style because he's showing off all the time, but in the end, we have to admit that he's an intelligent person and he raises some interesting points that we can learn a lot from them. So now, if you're a beginner in trading and you read his books, you might be left with the idea of very cool concepts like black swans or anti-fragility or barbell strategy, but you don't really know how to put them into practice to profit from them because he doesn't really say. So that's why I made this book to explain a little bit what he was really doing. Well, in case you don't know, Taleb was basically an options trader. He was trading in Wall Street during the 80s and 90s and became an expert, even wrote technical books about options. Now, what is an option? An option is actually a financial instrument that allows you to pay a price now to be able to buy or sell that asset at a different price in the future. So they are basically perfect to speculate with them. And Nassim Taleb was an expert doing this. The main concept is that he realized that mathematical models that people were using them and they still use now to price options assume constant volatility. So so-called experts were saying that the volatility of the market across time was constant, and that is not true. So he realized the options were mispriced, and then he used different methods that measure different volatilities in different periods because a bull market and a bear market have nothing to do. Volatility changes a lot. So using these methods, he saw during the financial crisis before 2008, he saw that during the bubble, the prices for the options were very cheap, or he thought they were very cheap compared to the risk that the market would crash. So he bought options in the financial sector, in real estate companies, these kind of assets that he thought were cheap. And then it turned out he was right. They were cheap because he paid that price, and then in the future, when he could exercise them, he made a huge profit. So this strategy is difficult to implement for a beginner. You need to understand that in the time in between you are waiting for to exercise your option, then you are losing money. So until the market really crashes, you have to put up with the pressure of be losing money. That's why he advocates for strategies like the barbell strategy, where you put 80% of your portfolio in very safe assets like bonds, and you leave only 20% for very risky assets like these type of options that are supposed to raise exponentially in time. So yeah, basically this is what he was doing. Now, if you want to see how to do this programmatically, I will link to my Medium article in the description of this video. And there I will explain how to use the Black-Scholes formula, which is the most common formula used by online brokers these days, to price an option. This assumes constant volatility. Then I will use a different model, like the Heston model, to show you that you can find a different price for the same option if you don't assume that volatility is constant. And this will let you see very clearly that there is a big discrepancy in the prices. And this is what you exploit to make money in the way Taleb was doing. So yeah, I hope you find it useful. Hit the subscribe button if you like my channel. And let me tell you that my goal with this channel is to democratize quantitative trading. And I made my own model that I use for my investment available under the link that you can find in my YouTube channel description. Bayesian Risk Balancer / subscribe. There you can subscribe to my model. Well, thank you very much and hope you enjoy it. See you in the next video.